This is Munehisa Honma, a rice merchant from 18th century Japan who turned market analysis into an art form and made over $10 billion in today's money. Yes, you heard me right, $10 billion. And what's even crazier, he did this without computers, without the internet, without even basic calculators, just rice paper, ink, and pure observation of human psychology. He's the man who invented candlestick charts, the same charts you're using right now on TradingView. Every single candlestick you see on your screen exists because of this one trader from 300 years ago. But here's what most traders don't know. Honma didn't just create pretty charts. He developed a complete trading system based on market psychology that allowed him to achieve over 100 consecutive winning trades. 100 consecutive winners! His success was so legendary that the Japanese government appointed him as their financial advisor, and he was given the highest honor a merchant could receive. He was raised to the rank of honorary samurai. Now, I know what you're thinking. How did a rice trader from the 1700s figure out something that most modern traders still struggle with today? Today, I'm going to show you the exact system Honma used, from the candlestick patterns he created to his legendary Sakata Five Methods, and most importantly, how you can apply these 300-year-old techniques to modern markets right now. Let's get straight to it. Before we dive into Honma's strategies, let me tell you the story of how he made his fortune, because this story reveals everything about how he thought. Honma was born in 1724 in Sakata, Japan, into a wealthy rice merchant family. When his father died, young Honma inherited the family business and decided to trade on the Dojima Rice Exchange in Osaka, the world's first organized futures market. The Osaka Exchange was about 600 kilometers from Sakata, roughly 370 miles. And remember, this was the 1700s. No phones, no internet, no telegrams. But Honma's trading strategy required knowing the daily price movements from Osaka. So what did he do? He created a network of messengers stationed every 6 kilometers along the entire route from Sakata to Osaka. These messengers would relay price information using signals and runners, allowing Honma to receive market data faster than anyone else. He basically built his own information highway 300 years ago. But the information network wasn't his only edge. Honma spent 15 years meticulously recording rice prices on rice paper, studying over 150 years of historical price data. Day after day, year after year, he documented every price movement looking for patterns. And that's when he made his breakthrough. He discovered that markets weren't just driven by supply and demand, they were driven by human emotion, fear, greed, hope, and panic. He realized that by tracking price movements in a specific visual way, he could actually see the psychology of other traders playing out on his charts. This insight led him to create what we now know as Japanese candlesticks. Honma went to the Edo markets, what we now call Tokyo, and this is where the legend really took off. Historical records claim that Honma achieved over 100 consecutive winning trades.
God damn!
Now let's talk about how he actually traded. What were these candlestick patterns he created, and how can you use them today? Honma identified that every candlestick tells a story. Each candle shows you 4 critical pieces of information: the opening price, the closing price, the highest price, and the lowest price during that period. The rectangular body shows the range between open and close. The thin lines, called wicks or shadows, show how far price moved beyond that range. When the closing price is higher than the opening, buyers were in control. When it closes lower, sellers dominated. But Honma took this further. He studied 5 specific candlestick formations and gave them names based on what they revealed about market psychology. These 5 methods described how every market moves, from accumulation to trend, from exhaustion to reversal. Honma called them Sakata Goho. That, in Japanese, means the 5 strategies of Sakata, named after his hometown. The Sanzan, Sansen, and Sanku are categorized into trend reverse patterns, and the rest of the 2, Sanpei and Sanpo, are trend continuation strategies. The first method is Sanzan. San means 3 in Japanese, and Zan means mountain. So Sanzan literally translates to 3 mountains. This is what we now call a triple top or triple bottom. When price forms 3 peaks at roughly the same level and fails to break higher, it signals that the uptrend is losing strength. Honma said this was the market's way of announcing that the climb is over. After 3 failed attempts to push higher, buyers are exhausted and sellers are ready to take control. Watch what happens here in this example. The market was bullish, pushing higher and higher. You get 3 tops, 1, 2, 3, all at the same or similar level. Notice how I said similar level, because these peaks don't need to be pixel perfect. The market is telling you that there's massive resistance at this zone, and the bulls simply can't break through. The resistance becomes too strong, and instead of breaking higher, the market reverses completely. The same principle works in reverse with triple bottoms. Here's a perfect example where the market was trending down, but then you see 3 bottoms at nearly identical levels. Each time the price hit this zone, buyers stepped in with force. This creates what we call a support zone. And when you see this pattern, get ready for a potential bullish explosion. It works beautifully across any time frame. Whether you're looking at weekly charts or 5-minute scalps, this pattern has the same powerful effect. Now let me show you a variation. It's called Sanzan Tenjo. You probably know this as the head and shoulders pattern, and it's one of the most famous candlestick formations in the world of trading. Look at this structure carefully. You have 3 tops, but the middle one sticks out higher than the other 2. It's like seeing a head between 2 shoulders. When this appears after a strong bullish trend, it's the market's way of saying this rally is exhausted. The buying pressure is dying and sellers are gaining control. The beautiful thing about this pattern is how it plays out. After the market forms this head and shoulders structure, it typically breaks down through what we call the neckline. This breakdown often triggers massive selling from traders who finally realize the trend has changed. And just like the regular Sanzan pattern, this works in both directions. The inverse head and shoulders at market bottoms can signal powerful bullish reversals. When you master these formations, you'll start seeing them everywhere and you'll understand exactly when trends are about to shift. Next, there is the second method called Sansen. We're talking about 3 candle reversal patterns that can give you incredible precision in your entries. San means 3 again, and Sen means river. Picture 3 rivers flowing parallel together. That's the imagery behind this pattern name. Let me break down the 5 main types of Sansen patterns, and I guarantee you'll recognize these from your own charts. First up is the star pattern. This is one of my absolute favorites because it's so clear when you see it. The market has been bearish, diving lower with strong selling pressure. Then suddenly, after a big bearish bar, you get a doji candlestick. This doji is what we call the star. Here's what's happening behind the scenes. The market was completely controlled by sellers, but now there's indecision. The star represents consolidation, like the market is taking a breath and deciding which direction to go next. The magic happens when you see what comes next. If the following candlestick becomes bullish and closes above the doji high, you've just witnessed a complete trend reversal. This is called Sansen Ake no Myojo in Japanese, or the morning star in English. Professional traders love this pattern because it gives such clear entry and exit signals. The opposite works perfectly too. When you see this star pattern after a bullish trend, it's called Sansen Yoi no Myojo, or the evening star. Same principle, just flipped. The market shows indecision after strong buying, then confirms the reversal with a bearish close. Honma's wisdom was beautifully simple. The pause is not the enemy. It is the moment before the path reveals itself. That doji isn't confusion. It's the market saying, stop, watch closely. Something powerful is about to unfold. Look at this chart example. The market dropped initially, then reversed completely, creating this support level. After pulling back, price reached that same support level again and formed a doji candlestick. That doji isn't random. It's appearing at a key support level and indicates a pause influenced by potential reversal energy. The market is basically testing that support, showing indecision right at the critical level. This is your cue that buyers are likely to step in with force. Look at what happened next. The market moved up again, exactly as the doji predicted. Moving on to the second Sansen pattern, the harami or inside bar. When the seed rests in Earth's embrace, invisible roots prepare explosion in secret. This pattern is absolutely beautiful in its simplicity. The market has been trending down with strong bearish pressure. Then you get a bearish bar whose high and low completely contains the next candlestick. The second candle fits entirely inside the range of the first one. The bears were in complete control with that big bearish bar, but then their momentum completely dies. The next candle shows such weak movement that it can't even break out of the previous bar's range. The key to trading this pattern successfully is patience. Wait for the breakout confirmation. When the market finally breaks above the high of the inside bar, that's your signal that the reversal is real. The probability of success jumps dramatically when you wait for this confirmation rather than jumping in too early. Let me show you a real chart example that perfectly demonstrates this principle in action. Look at this setup. The market was trending down with strong bearish momentum. Then it started consolidating. After some time, the market broke above that range, signaling a potential trend reversal. Now here's where most traders make a critical mistake. They jump in immediately, thinking the breakout confirms everything. But notice what happened right after that breakout. An inside bar formed. This candle represents a completely normal pause in the market. After any breakout, traders become uncertain. Nobody knows yet whether this is a genuine breakout or just another false signal. Munehisa viewed this moment as a golden opportunity, not confusion. For him, that inside bar after a breakout was the market's way of saying, hold on, final confirmation is coming soon. His approach was brilliantly simple yet incredibly effective. He would wait patiently and enter only once the inside bar broke in the direction of the new trend. Look at what happened next. Once price broke above the inside bar, the market continued moving higher with tremendous momentum. This is the power of patience and proper timing. Now let's look at the Susimi pattern, which is the complete opposite of Harami. We call this the outside bar. This formation shows incredible power and momentum. When one candle completely covers the previous one, Honma saw it as a dramatic shift in market power. The stronger side, whether buyers or sellers, had not only fought back, but completely erased the previous session's emotion. When one day fully embraces the next, the heart of the market has already turned. Here's how this works. A bullish engulfing forms after a decline. The green candle covers the entire body of the previous red candle, showing that buyers have seized full control. A bearish engulfing does the opposite after rallies. The red candle swallows the previous green one, revealing that sellers have taken command. For Honma, the engulfing candle wasn't just about size, it was about pure emotion. It meant that one side's conviction had completely crushed the other's hesitation. He often combined engulfing patterns with key levels or after doji formations to confirm reversals, what he called the market's confession. The fourth pattern is called kirikomi. After a strong bearish bar drives the market lower, the next candlestick opens exactly at the close of that bearish bar and then becomes bullish. This is significant because it shows the bearish momentum is dying. Instead of gapping lower or continuing the downtrend, the market immediately reverses from the previous close. The sellers can't push any lower, and the buyers are ready to take control, so potential reversals ahead. Finally, we have the Takuri pattern, and this might be the most visually obvious reversal signal you'll ever see. Takuri refers to a candlestick with a long wick pointing down, and it implies a trend reverse from bearish to bullish. A long shadow below is the market releasing its weight. Here's what this pattern tells you about market behavior. The market opened, sellers drove it much lower during the session, but then something powerful happened. Buyers stepped in with such strength that they pushed the price all the way back up, creating this long lower wick with a small body. This is institutional absorption at work. Big money stepped in to absorb all the selling pressure, and that long wick represents their buying activity. When you see this at market bottoms, especially with confirmation from the next candlestick closing above the pin bar, you're looking at a high probability reversal setup. At market tops, this same formation is called kubitsuri, or the hanging man in English. After bullish trends, when you see this long-wicked candle, it often signals that the buying is exhausted and selling is about to take over. Look at this setup carefully. The market is trending down with strong bearish momentum. Then it hits this key support level and reversed completely. After that initial bounce, price moved down again and touched that exact same support level. But here's where it gets really interesting. This time, a Takuri candle formed, right at that critical zone. That candle shows that sellers made their final attempt to break through support, but they completely lost the battle against determined buyers. Look at what happened next. The market went up exactly as the Takuri predicted. The patterns we just covered, Sanzan, Sansen, and Sanson Tenjo, are all trend reversal patterns. They signal that the current market direction is about to change completely. But Honma also identified two powerful trend continuation patterns, Sanpei and Sanpo, formations that tell you the current trend will keep moving in the same direction after a brief pause. The first continuation pattern I want to share with you is called Sanpai. This translates to 3 soldiers in Japanese. This pattern shows you when the market is marching with unstoppable momentum in one clear direction. Picture this, you have 3 bullish candles marching upward like disciplined soldiers, each one closing above the previous candle's high. It doesn't have to be exactly 3 candles, you can have 4, 5, or even more candles following this same principle. Watch what happens when you spot this pattern. The closing price becomes above the previous candle's high, then the next candlestick close becomes above that previous high, and it just keeps climbing like a perfect staircase. But wait, not all Sanpai patterns are created equal, and this is where most retail traders get burned. There are specific variations that actually signal the end of a trend, and recognizing these can save you from devastating losses. The first warning signal is called Sanpai Hanabi, which literally means time bomb, or firework with a timer. Picture this scenario. You have strong bullish candles, but then you notice something disturbing. The candle bodies start getting smaller and smaller, while the upper wicks keep stretching longer and longer. This is the market screaming at you that the buying pressure is exhausting itself. When you see this pattern, professional traders know it's time to take profits, not chase the move higher. The second warning comes through a pattern called Sanpai Sakuzamari. The last candlestick develops a massive lower wick, pointing downward like a dagger. This indicates the bears are starting to test the waters, and the uptrend might be running out of steam. When you see candlesticks reaching progressively higher highs, that's healthy Sanpai. But the moment you notice those candle bodies shrinking with long wicks pointing in the opposite direction, that's your cue to either take profits or prepare for a potential reversal. Now let's talk about the second continuation pattern. Sanpo is a brilliant continuation pattern that appears when the market is trending strongly, then suddenly pauses with a series of smaller candles. You'll see formations like inside bars or dojis appearing right in the middle of powerful trends. Most amateur traders panic when they see this pause. They think the trend is over, they think momentum is dying, so they close their positions right before the biggest moves happen. But Honma understood that this pause isn't weakness, it's the market gathering strength for the next explosion leg. He used this formation strategically to add to his existing positions, and his philosophy was, the warriors pause to sharpen the blade. This is where fortunes are made, when you understand that the pause is just preparation for the next powerful surge in the same direction. Remember, Honma developed these strategies because he understood something profound about markets. They're driven by recurring psychological cycles. Fear, greed, hope, and despair create predictable patterns that repeat across all time frames and all markets. When you learn to recognize these patterns, you are essentially seeing the market through the same lens that made Honma legendary. That's all for this video. See you guys next time.